Right now, shares of ON Holding AG, ticker ONON, are trading at $41.94. That is a massive, staggering move of over 19.2% just today. The volume is enormous, with tens of millions of shares changing hands, absolutely crushing its daily average. Now, the easy assumption, the surface-level expectation, is that this is just a volatile reaction to a simple earnings beat. In this market, investors are desperate for any good news. But that assumption, that expectation, completely misses what is actually happening. The reality hitting the tape today is something else entirely, and it's a fundamental shift in the narrative for this company. This isn't just about selling more shoes. This is about a company that just reported a gross profit margin of 65.7%. Let me repeat that, 65.7%. That is a 510 basis point expansion from the same time last year. That is a software-level margin, not a footwear margin. On top of that, their apparel segment, which many on the street had written off as a marketing accessory, just grew sales by over 86%. This 19% spike isn't a relief rally, it's a profound re-rating of the entire business model. For the last couple of years, the common belief about ON was pretty clear. It was the Roger Federer stock. It had that distinct Swiss-engineered cloud sole. It looked cool, and it was a plucky, premium disruptor taking shelf space from the legacy giants. The expectation was that this was a high-growth story, yes, but one that was perpetually vulnerable. It was seen as a niche player, susceptible to fashion trends, and most critically, at risk from a consumer slowdown. The narrative was that when discretionary spending tightened, a $180 pair of running shoes would be the first thing to get cut. Investors were worried that its high valuation, which often rivals tech names like Nvidia stock, was unsustainable if growth showed any sign of slowing. But that narrative, that expectation, completely misses what is actually happening. The reality hitting the tape today is something else entirely, and it's a fundamental shift in the narrative for this company. This isn't just about selling more shoes. This is about a company that just reported a gross profit margin of 65.7%. Let me repeat that. 65.7%. That is a 510 basis point expansion from the same time last year. That is a software-level margin, not a footwear margin. On top of that, their apparel segment, which many on the street had written off as a marketing accessory, just grew sales by over 86%. This 19% spike isn't a relief rally. It's a profound re-rating of the entire business model. Let's get into the specifics of this quarterly report, because the details are what's driving this re-rating. Net sales for the third quarter came in at $992.89 million, handily beating consensus estimates. On a constant currency basis, that's a 34.5% increase. But the real story, the part that has institutions scrambling, is the profitability. The consensus estimate for earnings per share was around 34 cents. ON delivered 50 cents. That's a 47% beat. That kind of earnings surprise doesn't just happen. It was driven by that jaw-dropping 65.7% gross margin. Management attributed this to a favorable product mix, operational efficiencies, and the continued strength of their direct-to-consumer channel. This wasn't just a good quarter, it was an execution masterpiece. This is where we see the difference between retail sentiment and institutional validation. You can be sure that major holders, firms like Fidelity, which according to the latest filings is one of the largest institutional owners with a massive 8.86% stake in the company, are ecstatic. This report validates their thesis. This isn't just traders on the Robinhood app chasing momentum. This is Fidelity Wealth Management and other large funds seeing their conviction play out. This is why sophisticated online investing platforms are so critical. If you are a self-investing individual using the Fidelity trading platform or the Interactive Brokers platform, you have access to this data in real time. You can see the analyst upgrades that are already starting to pour in. Any analyst who had a hold or sell rating on this name this morning is facing serious questions from their clients. This kind of report, especially the raised guidance for the full year, forces a complete rewrite of their models. This creates a powerful tailwind as new higher price targets are set and funds that were underweight are forced to buy the stock at these new higher levels. A huge part of this margin story is the direct-to-consumer or DTC channel. DTC sales grew by 27.6% or 37.5% in constant currency. This is vital. When a customer buys directly from ON's website or one of their flagship stores, the margins are significantly higher than selling through a wholesale partner. This is a strategy that Apple stock perfected with its Apple stores. It allows ON to control the brand experience, own the customer data, and capture the full retail value of its product. This is why many people who use SoFi Invest or Robinhood for Robinhood stock trading are also customers of the brands they invest in. They see the strategy in action. When you build a premium brand, you want to own the premium customer relationship. Even if you use SoFi Active Investing or just have SoFi stocks in a managed account, this DTC shift is a powerful tailwind for long-term profitability. Of course, a single stock surging 19% like this highlights the risks and rewards of concentrated positions. Many people prefer a more managed approach like Schwab Intelligent Portfolios or a SoFi Robo-Advisor. These services, which are a form of intelligent portfolio management, are designed to smooth out this kind of volatility. They provide investment help by diversifying your investment across many assets, often using broad Fidelity ETFs or Fidelity mutual funds. They will almost certainly not have a 19% day, but they are also protected from a 19% drop. They're designed for steady long-term accumulation, perhaps inside Fidelity IRAs. But they will also likely miss the full upside of a day like today. It's the classic trade-off in any online investment strategy. An active trader using Interactive Brokers for Interactive Brokers stock trading is having a very different day. They are likely managing a position they've built over time, possibly using the lower Interactive Brokers fees to trade actively around the news, and their individual brokerage account reflects that high-conviction, high-risk approach. And we have to come back to apparel. This was the market's biggest blind spot. The expectation was that ON was a shoe company, and apparel was a distraction. The reality is that apparel grew 86.9%. This is how you build an ecosystem. You sell the $180 shoes, and then you sell the $120 running shorts, the $200 jacket, and the $50 hat. This dramatically increases the lifetime value of each customer. This is what Lululemon did. ON is now proving it can do it too. This is what separates them from competitors. While some competitors are talking about a cautious consumer, ON is proving their premium customer is resilient. This is the kind of divergence that active managers using a Fidelity brokerage account or an Interactive Brokers account are paid to find. For anyone new to the ONON story, what does this company actually do? Born in the Swiss Alps, their entire brand is built on a unique cushioning technology called Cloud Tech, those little pods on the bottom of the shoe. It was designed to create a feeling of running on clouds. They started by building credibility with elite runners and triathletes, a classic win-the-core strategy. Then, in a brilliant move, they brought on tennis legend Roger Federer as a co-entrepreneur and investor, which gave them immediate global lifestyle credibility. Their business model is threefold: wholesale, selling to specialty running stores and high-end retailers; direct-to-consumer, their own website and increasingly their own flagship stores; and the rapidly expanding apparel and accessories line. This quarter proved all three engines are firing. So where does ON Holding go from $41.94? After a 19% surge, the expectation has been reset. The market will now demand perfection. The new narrative will be that this is the next great global sportswear brand, and any quarter that doesn't show massive growth and margin expansion will be punished. The reality is that this is where the hard work begins. Execution at this scale is incredibly difficult. The catalysts are clear: continued DTC growth, proving the apparel segment can become a billion-dollar business on its own, and the expansion of their physical retail footprint in key cities. The risks are just as clear. At this new valuation, any slip-up, a rise in inventory, a slip in margins, a bad product cycle will be severely punished. And competition isn't sleeping. Hoka is still growing like a weed. Nike and Adidas are not going to simply cede the premium market. This isn't a stock for